Okay, let's start to build up your knowledge of central banks. First, we're going to start off with history. We're then going to move this on through functions and then the operations. These are the bits that you really need to understand and the bits that are going to create, potentially, trades for you in the future. So, going back to the 1500s, there was a lot of trade, but there wasn't much of a monetary system. Trade was done between small banks backing smaller companies within their own country. International trade was quite difficult, high risk, and often wasn't cashless, so required you actually taking physical cash to complete your transactions. This began to change in the 17th century with public exchange banks. These sought to make the system a little bit more efficient and facilitate more and more international trade. This was at a time when international trade was beginning to really boom. You'd seen the exploration of the East Indies, the West Indies. So there was a need for this facility. This then developed further. In Amsterdam, the Wisselbank in 1609 was created, and this took on initially the first roles of what we see as a central bank nowadays. It took from the government the job of printing money, and it did then start to settle national and international transactions by allowing different banks and different institutions to hold balances at the Wisselbank. Modern central banks, you could say, have then further built up from the Bank of England's establishment in 1694. Now this, as with many banks and many bonds in the past, was created to fund a war, the 9 Years' War with France. UK government needed money. At the time, the UK government's credit was pretty poor. There was a distinct lack of willingness to lend to the UK government. So what was proposed is that the lenders that they found become incorporated. These lenders would then be given the ability to print banknotes, taking that away from the government and also to then fund the government. Incidentally, the amount of money needed was 1.2 million. However, whilst the Bank of England was supposed to have the exclusive right to print banknotes, provincial banks were still doing this until the 1840s. Roll on the Bank Charter Act, 1844. This made it legally a monopoly for the Bank of England solely to print banknotes. Now we'll talk about why a monopoly on printing money is so important a little bit later down the line when we look at functions and operations. However, this was also the beginning of the gold standard. Any printing of banknotes had to be done against an equivalent amount, 14 million, worth of gold or government debt. This created an obvious limit of supply. If we couldn't have any greater gold reserves, no more money. So that was the difficulty of having a gold standard and a currency backed by gold. 1870 as well, Bank of England took on more of what I'd seen as modern functions of a central bank. They started accepting the role of lender of last resort. This was on the back of the Overend Gurney Company crisis. I'll allow you to read that in your own time. But effectively, it was a wholesale bank that had a bank run on it, creating a big drain on liquidity in the economy. The Bank of England had to step in, lend money to make sure it didn't create a further collapse within the economy. Now, other roles that we see as synonymous with central banks started to build up in the 18th, 19th centuries and predominantly included managing currency and gold reserves, financing governments, regulating banks and controlling money supply. The control of the money supply and how they do that is really the main focus that we want to be looking at. How they regulate a bank is rarely going to create too much of a trading opportunity, whereas how they manage the money supply is fundamental to how markets trade, how borrowing and lending function within the economy. So that's where we're going to focus, that's where the trades are, that's where the opportunities are. So moving on, central banks we're going to be talking about are going to be the Bank of England, the ECB, European Central Bank, the Federal Reserve of the US and the Bank of Canada. Now you would have thought that these are very old institutions. In fact, apart from the Bank of England, they were all created in the 1900s. The Fed in 1913, Bank of Canada in 1934, and much, much later the ECB with the advent of the euro in 1998. Now, a quick note on the gold standard and fiat currency and the difference between the two. With a gold standard or a gold-backed currency, you need a certain amount of gold to print money against. You can't, as we saw in that Bank of England example, print more money than the amount of gold that you have. Whereas with a fiat currency, this is a promise to pay effectively, that a promise that your money is worth something and will be honoured to that value. As long as everyone believes in the value of that money, then it's fine. It doesn't need to be backed by anything. And a prime example of this at the moment is Bitcoin. Whilst there is no inherent backing of Bitcoin, there's not even a central bank behind it, as long as people believe that it is a means of exchange and a way of transferring money or converting goods into money or goods into different goods, then it becomes a currency. And that's very much the example of a fiat currency. Now, as I mentioned, having a currency backed by gold creates supply limitations. It also prevents any kind of quick monetary response to a crisis. If you have, for example, that liquidity crisis that Bank of England had and not sufficient gold reserves, then you run into trouble that you can't provide the liquidity because you don't have the gold reserves to print the notes against. So what you need almost is a standardized way of doing this, and that's what Bretton Woods was seeking to achieve post World War II. What it tried to do was establish convertibility of gold to the dollar. At the time, the US was the biggest manufacturer in the world, held the greatest gold reserves in the world as well, so it seemed the obvious thing to peg world's currencies to. What this meant was effectively almost worldwide pegging to the dollar, and the dollar was then pegged eventually to $35 per ounce of gold. Now, that's fine whilst the US is the main superpower. Come 1971, what you were seeing was actually a change in this situation, but the pegging remained. So you saw large dollar inflows into America caused by outflows whereby people wanted to convert their dollars into gold. So you were effectively getting inflation, meaning that the dollar was effectively overvalued whilst other currencies were undervalued. Other currencies, i.e. Deutschmarks, Japanese yen, their governments were not willing to then allow that to correct because they were currently in a good situation for exporting goods. So what happened eventually, the US was forced into it by an inability to fund the Vietnam War, and they pulled out, effectively meaning that currencies then floated themselves, meaning that each currency had an exchange rate to another currency and was then managed by their own central bank. And that's how we've now got to the current situation where almost all currencies are a fiat currency. There are a few still pegged to the dollar and even less still pegged to gold. Okay, so post Bretton Woods, we then saw what is now seen as a modern central bank. Most banks have retained a degree of alliance with others and have broadly the similar functions. Each bank has their own way of carrying out these functions, and some banks have a greater degree of certain functions than others. However, they all broadly follow a very similar pattern. Main thing being managing the supply of money and the cost of credit. Now this is where that monopoly printing effect comes in. If you're the only person who can print money, you then control the supply of money to the economy. Now the central bank does this by creating a liability. They print money, so it creates a liability on their balance sheet, which is then balanced by them buying things from the economy. Now they don't go out and buy directly supplies of things. They will generally buy very safe assets or overnight lending. So effectively they will buy a bond for an overnight lending from a commercial bank. Therefore they have an asset, the bond, and the liability, the money. Once that switches back, So the borrower from the overnight hands their money back. The central bank hands the bond back. That liability has now disappeared. That money has once again disappeared. Now, if you control the supply of money, you can then print additional money in times when the economy needs it. This alleviates liquidity issues, but also by printing more money, there's a greater supply of money. Therefore, people demand less interest to lend that money because they know that money is easy to come by. If I have lots of money and someone else has lots of money, there's a fight between us to lend that money out, and to compete, you will lower your interest rates. So increasing the supply of money will actually lower interest rates in the economy generally, thereby reducing the cost of credit, or heightening it by reducing that supply of money and slowing the economy down. Right, supervising commercial banks. This is reasonably self-explanatory. Central banks will have a very close relationship because all commercial banks need to hold balances at the central bank. So they'll have to hold a certain amount of money at the central bank. They are then supervised by the central bank as well in how they conduct their policies, or how they conduct themselves, more to the point. Central bank will also manage foreign reserves and gold reserves. Essentially, the reason for this is to make sure they don't end up with an excess of a certain foreign currency due to trade between different countries and certain currencies being deposited at the central bank. Effectively, this is quite a small area of their central bank operations and doesn't really affect markets to a great deal, barring the sudden sale of a large amount of gold. And the majority of these kind of things are pre-announced as well. Now, I've mentioned the lender of last resort function. This is effectively increasing lending, so increasing that money supply when it's really needed. Now, the reason to do this is to avert a liquidity crisis. So as long as a bank has collateral to be posted, then the central bank will lend to them to prevent that liquidity issue. It could just be that one commercial bank perhaps can't borrow overnight from other banks to fund their operations. So all of a sudden, whilst they may have collateral, whilst they may have assets, no one wants to lend to them, creating a liquidity issue. Give you an example. You wanted to go out for dinner with your mates. You hadn't yet been paid. You know you're going to get paid, and you also own assets. You own some jewelry, you own a car. You have solvency there, you have assets. However, you don't actually have the cash at the moment, so you have a liquidity issue. That's when you need that liquidity. You need someone to lend to you. That's where you could step out to the central bank if, for example, your friends weren't willing to lend you the money. So that's where the central bank steps in at a time when liquidity is an issue for a solvent bank. Solvent bank posts that collateral, i.e. you would hand over your car for the evening, you would get lent the money, next day you'd hand your car back and you'd pay the money back. So that's the basic premise of a lender of last resort. Finally, almost all central banks have a mandate generally set by the government, and this guides their policies going forward and guides the majority of their operations. So this mandate usually, not exclusively, relates to either inflation, price stability, unemployment, various different phrases for it, but all central banks will have a primary mandate. Some will have a dual mandate in the case of the Fed, which we'll talk about later. And this is generally set by the government and what almost all of their policy is geared towards. Okay, so on to central banks' operations. Mostly we're going to be focusing on monetary policy. This, of course, is what has the biggest impact on markets. This is the interest rates, the quantitative easing that you hear so much about. This is how the central bank has the largest impact and chance to move markets, change behaviours, and that's what it's all about, essentially, changing behaviour of economic participants. And what monetary policy tries to do is either influence the propensity to borrow or to spend. If you're moving towards a deflationary environment, prices are dropping, wages are falling, unemployment's increasing, central bank will employ a more expansionary monetary policy. This will include cutting interest rates in extreme circumstances, buying assets. So that's your expansionary policy. Your more contractionary is an attempt to hold back on a growth in inflation. Inflation's going to erode the value of money. It will erode any of your savings as well. So if you've got a lot of money in the bank and you're in a high inflation environment, all of a sudden that money that you could buy something with this year, all of a sudden can't buy the same thing next year because the value of that item has risen. So a more contractionary monetary policy will try and raise rates, reduce people's propensity to borrow money and spend, and push people more towards saving money, which therefore reduces demand in the economy, slows the economy down. All of this is generally a function to control inflation, as I've just mentioned, lower unemployment. Economic stability is generally a catch-all phrase to cover these different aspects of the economic model, and so that often is what most central banks will try and move towards: economic or price stability. And finally, in some circumstances, to control exchange rates. This is a situation where you have some kind of pegging of exchange rates. Take the Swiss National Bank, for instance, where they had their exchange rate pegged to the euro. When they realised that they could no longer hold this peg, they gave up on it and allowed the Swissy to float naturally. So their monetary policy before that had been an attempt to weaken the Swiss franc, either by using their foreign exchange reserves of Swiss francs, so selling Swiss francs and buying euros to keep that relative strength between the two, or alternatively as well, keeping rates very low in Switzerland. Switzerland had some of the lowest rates in the past 10 years, and that was an attempt to maintain a weakness in the Swiss franc. So we'll move on from there, and we'll actually go and have a look at all the different parts of monetary policy, how they work, how they influence markets. First up, we're going to have a look at interest rates. Now, I put a nice little chart up here to illustrate just how big an impact interest rates have on markets generally. Interest rates govern cost of borrowing for businesses, cost of borrowing for governments, for individuals, for banks on loans. Every part of the economy is influenced by interest rates. So a central bank, by changing the headline interest rate, can have a huge stimulative or contractionary impact on markets. Nice little illustration here. If you have a quick look at this chart, this is a chart of the S&P, so not what you would typically associate with an interest rate product, i.e. normal interest rate products. You'd be thinking about bonds, more so about currencies perhaps. S&P, however, this illustrates companies borrowing and how much companies' cost of credit has been alleviated by a Federal Reserve interest rate cut. This was on January the 22nd, 2008, and the Federal Reserve, out of the blue, cut interest rates by 0.75%. So this is a big cut, and what we saw is the S&P futures move 5% in 1 minute. So that is a massive move. Just think about how big a 5% move right now would be in the S&P, 125 handles. So that's a very, very large move. And that's what they managed to do. In 1 minute, we got that big a move. So just shows how big an impact an interest rate move can have on the markets. And this, I think, is probably greater than almost any other instrument in terms of moving markets and creating volatility and trade. So let's go and have a look at how interest rates are actually used. More than one interest rate is used by most central banks, and that perhaps is a little bit of a surprise. So we're going to have a look through all the different interest rates and what exactly they mean. Okay, so there's three main interest rates. In general, these will then make up the interest rate corridor, which I'll show you in a chart in a little moment. First up is your refinancing rate. This is the main rate that you hear quoted. This is the main rate that you will have heard of via the Bank of England, the Fed, wherever it is. Now, the main rate is not the rate that the bank actually says this is what interest rates are. It's the rate that what they want is overnight lending between banks to be conducted at this rate. So eligible banks will then be able to borrow a specific amount overnight from the central bank, but also more importantly, they will then lend to each other at a similar rate. Because if you can borrow for that amount from the central bank, why would you borrow for more off another commercial bank? So that's how they set a floor for lending between banks. But also this is the rate that, because overnight loans from different banks to bank in the money market cost this much, that then gets passed on to consumers. Now, of course, it's then a cost of credit element as to why the Bank of England base rate may be 0.5% and your credit card is 18%. That's because they're extending short-term credit to you, who perhaps doesn't have quite the collateral that HSBC does, for example. So that's why you don't get the same rate as the Bank of England base rate. But the idea is it's for overnight lending, and this is where the bank will try and manage that rate for overnight lending as well, which we'll come on to in a moment in their open market operations. The refinancing rate is the rate that they want most interbank or money market transactions to be conducted at. Next up, you have a deposit rate. Now, this is the rate that the central bank pays on deposits held at the central bank. Now, it varies by different central bank. Some central banks will say this is only on excess reserves. So you will then have a level of reserves that you have to hold at the central bank, which every commercial bank does. Then anything above that amount held at the central bank will pay you interest on at a deposit rate which is lower than the refinancing rate. What can happen in some circumstances, particularly the European Central Bank at the moment, is they've actually lowered their deposit rate to negative. What this does is it basically makes it punitive to hold money at the central bank. You're getting negative interest on your money, so you're effectively paying the bank to hold your money there. Therefore, you're better off to take it out and lend it into the economy than you are to hoard cash. And that's why lowering the deposit rate can actually increase lending in the economy. Finally, you have a marginal lending rate, or in America this is known as a discount rate. Now, essentially, this is the almost rate you would have on lender of last resort money. So any emergency overnight loans, if all of a sudden a central bank needs an overnight loan to fix liquidity, they will be given that loan in exchange for collateral at the marginal lending rate. So a higher rate than the refinancing rate, because theoretically they should be able to refinance with each other at those prices. If they're not being able to get a loan overnight from another commercial bank at the refinancing rate, then clearly there is some issue with their credit or liquidity, and therefore the central bank will step in, but it will be at a slightly punitive rate. So we'll move on, and here we go. Here's a nice illustration of that rate corridor. What we've got here is the ECB marginal lending rate, the highest rate. You've then got the main refinancing rate and the deposit rate. The red line is the EONIA rate. What this is it's the rate that banks will actually charge each other to lend between each other. So it's actually lower than the refinancing rate, higher than the deposit rate. And this is what the ECB is aiming to do effectively. By having these two rates, you keep general lending within the economy within that band. So lending isn't done at a very fixed rate, it is done at a variable rate between banks. The overnight lending between banks is done in order to manage cash flow. For example, say one bank has had a large draw of deposits one day and needs a little bit of funding to make sure that their reserves are topped up, because every bank has to hold a certain amount of reserves. They may borrow overnight from another bank to fill this hole in. Perhaps that other bank has had an excess of deposits flow into it, so they have excess cash that they want to do something with overnight. They will lend it to the bank with a deficit on the basis that once some of these deposits come back, it is then switched back. But that extra borrowing overnight comes at a very small cost, but nonetheless a cost. And when that's done on billions of pounds, dollars, euros, that is actually quite a significant amount. So that's the idea of the interest rate corridor and how banks then aim to guide market in terms of interest rates, which are then passed on to customers. Once the central bank has set an interest rate, it then needs to manage how this interest rate feeds through into the economy. There's no point, as I mentioned earlier, with a central bank having a monopoly on the money supply. If there's very little money in the economy, even with an interest rate set at a certain low level, that lack of money, people will then demand higher and higher interest rates to lend the money out. So they manage this via open markets operations. Each time a central bank buys a security, it effectively creates money in the economy. Central bank prints or adds some extra money to the central bank money and then goes and buys securities from a commercial bank. What this then does is feeds money into the economy. The idea here is that by feeding money in or by withdrawing money from the economy, they can very short term tweak the interest rate. So these open market operations are done on a daily and weekly basis to manage the level of liquidity in the economy, so that the continual flow of money means that interest rates don't suddenly start to spike as money disappears somewhere or is hoarded because there being less money in the economy. So what the central bank does is it will either buy securities from certain eligible commercial banks or sell securities to them. That's how it manages this liquidity. It's done through one of two channels. Either through a repurchase operation, so the government injects liquidity by agreeing to buy bonds from a bank on the premise that they can then sell these bonds back at a later date. What this does is short term, it gives that bank and the economy or monetary system as a whole additional liquidity whilst it's needed, and then as that liquidity becomes less needed, the central bank then takes that back by way of selling those bonds back to the commercial bank. Commercial bank sends the money back, central bank cancels that extra money. So that money it created and bought the bonds with, it comes back and then effectively destroys. The reverse happens where a central bank sells assets, and this is a reverse repo operation or a reverse repurchase operation. So the central bank has a balance sheet of assets, government bonds, high quality commercial paper, overnight deposits. What it will do is sell these to commercial banks and take money out of the system. This money again effectively is destroyed or disappears, and therefore you've reduced the amount of liquidity in the system, and that serves then to increase rates of interest because of that limited supply of money. Cost of money therefore starts to rise. So we have a look here, we've got a nice little chart, and there's a distinction between a repurchase with that sale back and a reverse repurchase operation. The repurchase operation on the left, central bank buys the bonds, high quality collateral, for an agreed time. Money in circulation increases, they then sell them back and take that money out of the economy. So what's happened is the base level of money has risen and then falls back. With a reverse repo, what happens is the base level of money falls and then rises back up. So what happens there is the central bank sells its holdings, commercial banks hand money over, so take money out of the system, money's reduced, and then later on the central bank buys them back as there is a need to increase liquidity in the system. So that's how your reverse repos and repos work. This serves to enforce the exchange rate. Now, in terms of a trade, there's not a great deal in any kind of announcement on these. However, noticing how the continuation of the use of certain types of repo, or the size of these repos going for a certain period, gives you a sense of liquidity in the economy, gives you a sense of people's willingness to lend credit. If there's continual repurchase operations adding liquidity to the economy, then it's showing that there are some signs of a little bit of a stiffening up in people's willingness to lend in the economy. Now, a slightly less significant and less used method to manage the liquidity in the economy is the reserve requirement ratio. Now, I'll explain this in a little table in a moment, but the idea of the reserve requirement ratio is to have central banks maintain a certain level of their assets at the central bank. What this does is it means that they can't then lend out as much money as they would ordinarily be able to and create credits via the fractional reserve banking system. So let's have a look at this. Quick look at the table shows if someone deposits £100 at a bank, the bank then only needs to hold 10% of that at the central bank. They then lend out 90, so they've got an asset in the 90. They've deposited they've deposited 10 at the central bank, so they've got assets that match their liability being the deposit. That 90 then gets spent, put in another bank who does the same. Effectively, this £100 has now created more money in the economy, because the only element that's been taken out and held is the 10%. So that £10 are initially. So from that 100, we've now had 90 added, plus another 81 as well. So as you can see, as the table shows going forward, the amount that's held in reserve, that fraction, is not a great deal, meaning that more and more money is lent in the economy, creating, in fact, a total debt of 551. Now, this is seen as an asset to the banks, and their liability is the deposits. Chances are, and this is the whole theory behind it, that you're not likely to have every depositor want to take their money all at once. If that happens, that's where you get a bank run situation, and that's where the lender of last resort needs to come in. So the idea of reserve requirements is to take money out of the economy by raising the reserve requirement, therefore reducing a commercial bank's ability to create credit. Likewise, you lower that reserve requirement, and that enhances the commercial bank's ability to create credit, and therefore creates an expansionary situation in the economy. Now, this isn't that prevalent or that well used by central banks. Incidentally, the Bank of England and the Bank of Canada don't actually have a reserve requirement. The ECB has a 1% reserve, and the Federal Reserve has a 10% reserve. So that's where that deposit rate comes in. They only pay a deposit rate on reserves in excess of those reserve requirements. So Bank of England, Bank of Canada don't have any at all. This is most commonly used, or most frequently used, by the PBOC, People's Bank of China. They use it quite frequently and often specifically targeted at certain types of banks, rural banks, finance banks, whichever it is. So if you are trading, say, a cut in Chinese interest rates, you have to be very mindful of, is it a cut in interest rates total, as in their refinancing rate, or in their RRR rate, their reserve requirement ratio. If it's the RRR, then next step, is it a targeted one as well, which could end up meaning that it really doesn't have a great deal of impact on markets outside of China. So you've got to be thinking about that. China, as I say, is the most likely to provide you with a trade based on any kind of reserve requirement ratio. In Europe, it's more a capital adequacy ratio, whereby banks have to maintain a certain degree of their assets in liquid assets or cash to cover that potential depositor outflow. So that's how reserve requirements are used, and one of the sort of lesser tools in actually managing the amount of money in the economy. Standard monetary policy measures have been used, and they seem to be exhausting their ability to create any expansion in the economy. So interest rates have been cut. Repurchase operations have gone through the roof, and the central bank still can't get an expansion or a slowing down of a recession in the economy. What comes next? Extraordinary measures. This usually comes in when interest rates have hit zero. And first up comes quantitative easing. This came about in 2008-9 as an answer to the recession/depression that came about on the back of the US mortgage crisis. So quantitative easing, basically, I'm sure many of you understand this. Central bank goes out and buys government bonds, either in the primary market or the secondary market. What this serves to do is create a demand for bonds, which at the same time then pushes bond yields down, meaning that any new issuance of bonds can be done at a lower rate. This in general brings interest rates in the economy down, increasing people's propensity to borrow because they can do so at much lower rates, and then spend on other assets, spend on employing people, expanding businesses. So that's the idea of how quantitative easing works. Effectively, it's a repurchase operation, just without the second phase of it, where those bonds are then sold back to the bank. What the aim is, increase the amount of money in the economy. This, in theory, should then increase inflation and inflate the country out of this depressive stage that it's in. Next up comes QE expansion. Now, this can be done in various ways. The obvious way is you just increase the amount of bonds you're buying. Usually is a specified amount, say a certain amount per month for a certain duration of time. What can be done then is they can widen the net of what they buy, move more into corporate bonds that help company financing out, or move into other sort of lower risk bonds, i.e. municipal bonds. So that's more local government bonds. Or they can vary it in terms of time. So they could go an indefinite length of time, an indefinite amount of buying as well. They could say that we will buy unlimited, certainly in terms of time, and they would just say we will just continue these purchases for an unspecified amount of time. Finally, they could move into other assets. This is something the Bank of Japan's done. Bank of Japan has done various measures and really expanded their purchases. So they went through QQE, which brought about the indefinite length of time for their asset purchases, and then followed by buying other assets. So they've now moved into ETFs, and I believe Bank of Japan owns 50% of ETFs in Japan. Finally, and this is slightly less of a big deal, was Operation Twist. This was something that the Fed did. Now, Operation Twist served to shift the bond buying more from focused on short-term bonds, so 2-year bonds, for example. So what the aim of buying short-term bonds was to lower short-term interest rates, helping the monetary sector, banks, to then moving that out to longer-dated bonds, which help loans to consumers, as longer-dated bonds are more linked to consumer loans, to mortgages that are loans for a much longer period of time. So that's the idea behind Operation Twist. Next up, a little diagram of how exactly it works. So we've got, in this diagram it says the Bank of England, but this can be any bank. What happens is the Bank of England prints money, buys bonds from companies and pension funds, banks, etc. So Bank of England's balance sheet increases. They now have more assets on their balance sheet, those government bonds. The banks now have more money. This goes out in terms of lending, in terms of purchases. Well, once the money's lent, it turns into purchases of assets, more employment. Generally good news for the economy. So that boosts the economy, and we move on. These companies increase. They then pay their workers, buy other companies, pay for more jobs to be done. This increases the amount of money in the economy. Theoretically then, so as the economy expands, you then get a situation whereby you almost get this repurchase idea, whereby the money goes back to the Bank of England. The bonds, effectively, rather than being sold back, are left to mature. So as those bonds mature, the Bank of England gets paid the money for owning those bonds. So ultimately a bond is a loan, so if you hold the bond at its maturity, you get the value of the bond back. And then the Bank of England, rather than continue to invest this, then gets rid of the money, destroys that money, and that's how it steps back from the quantitative easing process. But ultimately, whilst quantitative easing goes on, this cycle continues, whereby as the bond pays back, the bank then reinvests that money once again and starts buying more bonds, or buying the same amount of bonds with that money that matures from the bonds. So that's how QE continues. It's only when the central bank starts to reduce its balance sheet by either selling off the bonds that it's acquired or allowing them to mature and getting rid of that money. Just a quick little illustration of how central banks' balance sheets have grown over time. What you've got, and note the scales, I see that all of the lines finish at the same point. The scale tells you exactly how much has been purchased, but what you've got is the purple is the Federal Reserve, green the Bank of England, and orange the ECB. You can see that the ECB's asset purchases actually only really started in July 2014. Prior to that, we had longer term refinancing operations, which we'll come on to in a moment, which increased the balance sheet, the orange line, which then dipped, and then QE expanded that once again. The Bank of England has stepped theirs up in stages, and they've always had, rather than a monthly purchase amount, a limit that they will meet and purchase up to. So that currently is 435 billion. The Fed has then seen theirs increase via QE, QE2, and then QE3 as well. Recently, you can see that's leveled off really from the end of 2013, and they've actually now started to reduce their reinvestment. So you're actually seeing the Fed balance sheet decrease, and it's expected now to decrease at least by around about half. So that's how central banks' balance sheets have increased, effectively showing the amount of additional money that's been created and pushed into the economy. So a final look at the last few extraordinary measures that a central bank can use. These are often measures that are used before QE, and it can be seen as a bit of a precursor to QE in a way. Things that perhaps aren't really picked up on. QE is very well publicised, but the smaller things that came before it were almost a precursor to it. So let's go and have a look at those. First up, you have what the ECB calls an LTRO. These are called various different things by other central banks: term lending facilities, extended term lending facilities, etc., etc. LTRO stands for a long-term refinancing operation. So a refinancing operation done over a much longer period. So effectively that's it. It's a longer term repo whereby you can borrow money at a fixed rate now for 3 years or more perhaps. Then, as with any other repos, this is sterilised, i.e. what happens is the central bank will buy the collateral off you, so hand you over money, with the premise that you will always pay this back. So that's the element of when you hear the word sterilised, that's what it means, that there is always a secondary agreement that this will switch back over, as opposed to QE where it never does. Next up, liquidity swap lines. These are done between two central banks. Now the idea is that a central bank can borrow from another central bank a certain amount of their currency. So this could be needed if there's liquidity problems in, say, the UK, in terms of UK banks are struggling with dollar funding. The central bank, so the Bank of England, could borrow dollars from the Fed, obviously charged interest in the same way that a bank would be to borrow from the Fed. Charged interest. They then have this dollar liquidity that they can lend out to the commercial banks within their jurisdiction. As always, the money is then paid back with an agreed interest on a certain date. So this has been used quite a lot early on in the financial crisis, where people had need for dollar funding in particular, and so there was swap lines opened up between the UK and the Fed, the ECB and the Fed and Bank of Canada, so various different swap lines. So that's the idea of it, to create other currency funding in your own country. And finally, something that has been mooted and never actually done, and potentially, and this is why I've put it up there, is something to keep in the back of your mind: helicopter money. Couple of ways this could be done. Either directly handing money to the public, i.e. everyone's bank account is credited with a certain amount of money, £5,000 for example. The idea of this is that with this extra money, you're more likely to spend it because it's seen as bonus money. You've done nothing for it. So that additional spending, which you're more likely to do, increases spending in the economy overall and jumpstarts the economy. Whereas if it's your own money, you're more likely to hold on to it, particularly as it's in a recessionary environment. You're not likely to want to start spending your own money. But if you're given some money, effectively free money, you will be much more comfortable in spending that money, and that's what should start to kickstart the economy. Now, the other way of doing this could be done in the form of a bond. Now, this bond would be called a perpetual non-callable zero coupon bond. So, let me explain this. Most bonds will have a maturity, i.e. a 10-year bond. This one will be perpetual, so it will not mature. It will be non-callable, meaning that the institution that creates the bond can't then call for that bond to be repaid, or the owner of the bond can't call for it to be repaid to them. Whereas with a 10-year bond, if you own the bond, you are then paid the money, the value of the bond upon its maturity. So you can't call the bond to be paid, and it will be zero coupon, therefore zero interest rate, effectively meaning that this is totally free borrowing for an unlimited period of time that cannot be called back. So that's how helicopter money could come from more financially based wording, and so something that, being aware of that, creates a very nice easy trade. It's a major flow of money into the economy, so should theoretically create movements in risk assets, i.e. purchasing of equities, would be seen effectively in the same way as an interest rate cut would be viewed. Okay, so that completes central bank operations. Hopefully you've now got a good overview of the way that a central bank manages monetary policy, some of the tools that they do this with, and some of the more nuanced or extraordinary ways that this can be done. Hopefully now you've had your eyes open to interest rates and how they actually work in practice, and also how a central bank manages these interest rates. So we'll move on now to actually look at how these things are announced. The central bank doesn't just suddenly do these things. They will have policy meetings throughout the year where they will update you on their policy decisions, on any new measures or any shifts in monetary policy stance. So we'll move on to that now, and we'll be looking at it in particularly from the point of view of how to prepare for these events. So it's all about building that framework up and knowing exactly what you're going to do in that situation. So we'll move on now, on to the next module.